We're jumping straight into Ciena today. Everyone is watching the price action, but the real story is the AI networking boom and their high-speed coherent optics.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button.
So to really set the stage for you today, we need to look at the sheer velocity of this recent market run.
Yeah.
Because on March 10th, the market saw this unusually sharp intraday surge. It was 8.9%.
Which is massive for them.
Huge.
Yeah.
The stock gapped up from $318.54 all the way to $346.89 in just a single session.
Right.
And when a company of this size makes a move that aggressive, it usually signals something shifting beneath the surface. It's a defining moment for the infrastructure side of tech.
And the volume, that volume is what really caught my attention.
Oh, yeah.
Because they're leading their optical tech peers right now and doing it with heavily elevated trading volume. That tells me this is institutional capital making a very deliberate choice.
Not just retail momentum.
Exactly, not just retail hype. We're seeing capital that was hyper-focused on the generative AI software layer.
Yeah.
The applications, the headline chip makers.
The shiny stuff.
Right, the shiny stuff. That capital is beginning to rotate. Investors are waking up to the fact that you just can't run these localized compute clusters without physically moving the data.
You need the pipes.
You need the pipes. The investment dollars are pivoting, and hardware networking is absolutely becoming the focal point.
Software dictates the narrative right now, sure, but physical infrastructure dictates the reality.
That's a great way to put it.
You can have all the processing power in the world, but if a data center chokes on its own internal bandwidth, that supercomputer is just stuck in a traffic jam.
Yep.
The chips just sit there idle, waiting for data. And that specific bottleneck brings us to the fundamental explosion we saw in their fiscal Q1 2026 earnings report.
Let's lay out those Q1 numbers, because expanding at this rate in a hardware-intensive business is, frankly, unusual.
That is.
Top-line revenue hit $1.43 billion. That's a 33% increase year over year.
Which is just a standout figure for physical networking gear.
Totally. But the bottom line is where the efficiency really shows up. Adjusted earnings per share jumped 111% to $1.35.
Wow.
Right. And for context, the street was looking for something closer to $1.17. So that's a 15% beat over consensus estimates.
And when you look under the hood to see where that cash is actually coming from, it's their optical networking division doing the heavy lifting.
Yeah, that segment alone brought in $1.02 billion of the total revenue pie.
Exactly. But we shouldn't ignore routing and switching either. It's smaller, bringing in about $126 million, but it's growing consistently.
Right.
The metric that is really reshaping how analysts look at this company, though, is the operating margin.
Oh, the margin expansion was incredible.
They took their adjusted operating margin from 12.3% and expanded it to almost 18%, 17.9% specifically.
Which, expanding margins by over 500 basis points while you're simultaneously scaling production, that is incredibly difficult to pull off.
It's almost unheard of in hardware.
It usually signals that a company isn't just moving more boxes to capture revenue, they're dictating the price.
Right, they have pricing power.
Exactly. They have pricing power because the tech they're selling has become absolutely mission critical. And that naturally leads us into their competitive moat, because you don't get a near 18% margin without a serious technological advantage.
No, you don't. And the foundation of that moat comes down to their 1.6T optics and their co-packaged optics.
Let's break that down for people.
Sure. So to put that 1.6T number in perspective, right now, most advanced data centers are scrambling to upgrade to 400 gigabit or maybe 800 gigabit speeds.
Just to keep up with current AI workloads.
Exactly. But Ciena is already laying the commercial track for double that capacity. And a huge driver behind this leap is the IP they acquired from Nubis Communications.
That Nubis acquisition really stands out in their recent timeline.
It does.
It seems like the integration of that IP is paying off way faster than the market thought it would.
Much faster.
Let's try to visualize what this technology actually does in a real-world setting.
Yeah, it really helps to use a practical analogy here. So imagine an AI data center as a rapidly expanding, heavily congested industrial city.
Okay, I'm picturing it.
Traditionally, to get manufactured goods, which is our data, out of the factories and across the city, You build a network of physical highways.
Right, and in a data center, these highways are your traditional copper cables.
Exactly, traditional copper and standard pluggable transceivers.
Yeah.
But as the city's output just completely multiplies, those highways take up way too much physical space.
They cause massive traffic jams.
Right, and moving those trucks requires a tremendous amount of fuel. In the server rack, that fuel translates to electricity consumption.
And electricity inevitably turns into heat.
Yes.
Which is the primary enemy of any high-performance computing environment. If those servers get too hot, they either throttle performance or they just fail entirely.
And then you need even more electricity just to run the massive cooling systems.
It's a vicious cycle.
Precisely. So instead of trying to build wider highways or add more trucks, imagine you invent a hyperspeed underground magnetic levitation train.
Okay.
And this train connects directly into the internal loading docks of every single factory.
Wow, so it bypasses the surface roads entirely.
Exactly. It takes up almost no extra surface space and uses a fraction of the energy to move 10 times the cargo. That is essentially what Ciena's hyper-rail photonics accomplishes.
So it integrates the optical engine directly with the silicon switch.
That's the co-packaged aspect of the tech, yes. By bringing the optics that close to the compute, they achieve up to 32 times the data density of legacy systems.
With significantly less power draw.
Exactly.
From a strategic business perspective, establishing that architecture creates a formidable barrier to entry. I mean, think about the hyperscalers, these massive cloud providers spending billions on these facilities.
Right.
Once they architect their physical server racks and their data flow around this highly integrated hyper-rail system, they are locked in.
Highly locked in.
The switching costs to rip all that out and replace it with a competitor system become astronomically high.
It's just not feasible.
Right, and this dynamic protects Ciena's market share from legacy optical competitors like Lumentum and Coherent. If you're building a competitive AI facility today, space density and thermal efficiency dictate every purchasing decision you make.
And that technological high ground is translating directly into their balance sheet. It's remarkably healthy right now.
They're funding all this rapid growth without burning through their reserves, right?
Exactly. At the end of Q1, they reported about $1.4 billion in cash and investments.
That's a massive cushion.
And looking at their cash flow, they generated $228 million in operating cash flow and a very clean $154 million in free cash flow just for the quarter.
Plus, they're actively reducing their net debt burden.
Right.
Generating that level of free cash flow while in the middle of a hardware scale-up really separates them from a lot of the speculative tech plays we see in the market.
Oh, completely.
Management is also broadcasting a really strong signal of internal confidence. They just repurchased 0.4 million shares for $80.5 million.
Utilizing their existing $1 billion buyback program.
Right. And when a leadership team is allocating capital to buy back stock while heavily funding R&D for next-gen AI infrastructure, it implies they view their own equity as undervalued relative to the pipeline they see ahead.
Which brings us to the forward guidance. And this might be the most scrutinized part of the entire earnings report.
The market was definitely waiting for this.
Management raised their fiscal year 2026 revenue guidance to a range of $5.9 to $6.3 billion.
So if we take the midpoint of that range, we're looking at a 28% growth rate.
Exactly. And this is a crucial data point for institutional investors. It suggests that the Q1 performance wasn't just a pull forward of demand.
It wasn't a one-off anomaly.
Right. It points to sustained, multi-quarter momentum driven by a structural shift in networking needs.
Let's unpack that dynamic for a moment, because the tension between AI hype and actual realized revenue execution is the defining theme in the market right now.
It really is.
Over the last year, countless companies have woven artificial intelligence into their earnings transcripts, hoping for a bump in their valuation multiple, but their actual build revenues stay completely flat.
They're just riding the buzzwords.
Exactly. But Ciena appears to be fundamentally distinct here. They are generating tangible revenue from this transition.
And the reason for that distinction is that co-packaged optics are not some optional luxury upgrade.
Right.
They are a mandatory engineering solution to a very real physical limit. When you cluster thousands of state-of-the-art AI processors together, the electrical signaling running over traditional copper simply cannot handle the required bandwidth over distance.
It degrades the signal.
It degrades the signal, or it consumes more power than the local grid can safely supply.
The hyperscalers literally have no choice but to transition to high-speed, coherent optics.
It's a structural necessity for the industry to move forward.
Yeah.
That locked-in demand is why a 28% forward growth projection actually carries genuine weight.
Looking at the flip side, we have to maintain our objectivity and evaluate the risks, because no stock stages a multi-day breakout of this magnitude without generating some distinct vulnerabilities along the way.
Right. And the primary risk hanging over the entire networking sector is the macroeconomic picture regarding capital expenditures.
CapEx is always the big question.
The big question analysts are asking is, what happens if the cloud giants pause their aggressive AI monetization efforts and slash their CapEx budgets?
Because we are in the middle of a massive hardware supercycle right now.
We are. But historically, hardware cycles always experience painful digestion periods.
That's true.
If the major tech players look at their balance sheets and realize they've overbuilt their AI capacity relative to the actual software revenue they're generating, well, purchase orders for networking hardware could be slashed overnight.
It is a valid concern, and it really echoes the telecom bust of the early 2000s.
Definitely.
Companies laid thousands of miles of dark fiber anticipating demand that took a decade to actually materialize. But the counter-argument to that bear thesis lies in Ciena's record Q1 backlog.
Right, the backlog.
They aren't operating order to order right now. That massive backlog acts as a heavy shock absorber against any near-term macro slowdowns.
It's a huge buffer.
Even if a hyperscaler taps the brakes on future facility announcements tomorrow, Ciena has a mountain of existing, legally contracted demand to work through. It essentially secures their revenue floor for the foreseeable future.
A robust backlog is definitely a strong safety net. But we also have to remember backlogs can sometimes face delays or renegotiations if the macro environment deteriorates severely enough.
Fair point.
The other major component of the bear case is the valuation stretch. We talked about the stock surging nearly 9% in one day.
Yeah.
The current news cycle is overwhelmingly bullish, and sentiment across the optical sector is incredibly elevated. When a stock is being carried upward by this much momentum and optimism, the valuation is being severely tested.
The market is essentially pricing the company for absolute perfection going forward.
Precisely. Any slight compression in that 17.9% margin, or any unexpected delay in the commercial rollout of their 1.6T optics, could trigger a sharp and unforgiving pullback.
The push and pull of high expectations versus strong fundamentals is definitely the core tension here. You have a stretched valuation battling against very strong cash reserves and a dominant product pipeline.
Right.
But when management steps up and confidently raises the full-year growth outlook to 28%, they are implicitly telling the market that the current premium valuation might actually be justified provided they execute flawlessly.
That's the key.
The margin for error is undeniably thin at these price levels, but the growth vector is also historically steep.
It ultimately comes down to flawless execution over the next 2 to 3 quarters.
Yeah.
If they can continue to deliver near that 18% operating margin, while smoothly fulfilling the backlog and transitioning clients to the new hardware, the valuation concerns will likely take a backseat to the sheer scale of the earnings growth.
But that execution risk is the core vulnerability that needs to be monitored closely.
Absolutely.
Since we are monitoring this timeline closely, let's talk about the immediate horizon. If we look at the 30-day catalyst calendar, the absolute center of gravity for this industry right now is the OFC 2026 conference.
The big one.
That is happening in Los Angeles from March 15th through the 19th.
For the optical networking world, the OFC conference is the premier event of the year. It is the most critical near-term catalyst to watch.
What specifically should people be watching for?
What you want to pay attention to on the exhibition floor are the live booth demonstrations for their 1.6T optics.
Because seeing is believing for these hyperscalers.
Exactly. It's one thing to read about these speeds on a spec sheet. It is another entirely for attending hyperscaler engineers to see the hardware operating stably in scale in real time.
Right.
That is what ultimately drives the massive multi-year purchase orders. Also, keep a very close eye on any product reveals regarding quantum-safe technology and AI ops.
AI ops being artificial intelligence applied directly to IT and network operations.
Correct. Those are the next-generation features that will secure their dominance as we move into the 2030s.
Alongside the official demonstrations, there's an unconfirmed but compelling rumor circulating through the sector right now.
Oh, the amplifier rumors.
Yes. The whisper is that there are potential unannounced hyperscaler collaborations happening specifically around advanced optical amplifiers.
Which would be huge.
Huge. If we get any hints or even accidental leaks on the trade show floor that one of the top 3 cloud providers is co-developing or securing exclusive amplifier deals with them, that would represent a fundamental catalyst that is not fully priced into the current stock value.
Industry trade shows are notorious for those kinds of quiet, backroom development deals suddenly becoming public knowledge.
They really are.
While OFC is the immediate catalyst to track this week, you also need to circle June 2026 on your calendar.
Q2 earnings.
That's right. That is when we will get the Q2 earnings report. The market has already set a very clear bar here. Everyone will be looking for Ciena to perfectly hit the $1.5 billion revenue target they just guided for.
Anything less than that 1.5 billion mark and the valuation concerns we just debated will immediately surface.
Instantly.
It all comes down to meeting that mark in June. Let's bring it all together for the lowdown. The core narrative driving this breakout is clear. Ciena is riding a 33% revenue explosion, fueled by an undeniable AI networking moat that competitors are currently struggling to cross.
They really are.
They have the cash reserves, they have the expanding margins, and they hold the technological high ground with their co-packaged optics solving real-world data center bottlenecks.
It's a strong position.
Very strong. And before we wrap up, I want to leave you with this. With hyperscalers locked into an absolute arms race for data center efficiency, could high-speed optics like Ciena's hyperrail photonics become the single most critical bottleneck technology of the next decade? And if so, are hyperscalers too entrenched in this ecosystem to ever switch out?
That is the defining question for the long-term future of global infrastructure and something every tech investor should be thinking about. Thank you so much for tuning in today. Keep questioning the market's biggest moves. Stay curious, and we will catch you on the next one.